The most profitable company on the planet in 2018 has been named, and it is not Apple. Plus, the 5 times it makes sense to take a pay cut. Those two headlines, plus the big idea tying them all together, and so much more on today's Money in the Morning. Welcome to Money in the Morning. I'm Bobby Rebel from the Financial Grown Up Podcast, coming to you from my very grown up kitchen in New York City. This is the podcast where we cover 2 recent stories ripped from the financial press. Not only do we read them like some other podcasts, but we get into why they matter to you. And then we wrap it all up with a big idea at the end of today's show that you can take with you and make your own. Money in the Morning is brought to you by Tiller. Manage your money 10 times faster in a spreadsheet with Tiller, the only service that connects your banks to Google Sheets and Excel with your daily spending, transactions, and balances. Go to stackingbenjamins.com/Tiller for more info. All right. Hey, everyone. Joe Saul-Sehy, my partner, is not here today. He is busy helping his mom clean out the basement where he usually broadcasts from. But Laura is here with me. Laura, let's kick it off.
And now, your first Money in the Morning headline.
All right, everyone, and a special welcome to our Facebook Live audience joining us. If you want to be part of the live taping of the show, go to facebook.com/iStackBenjamins. Set yourself up for alerts, and you will get a little bell telling you, a little message telling you when we are getting ready to tape. We try to give at least a few hours of a notice, sometimes more, sometimes less. But we love to have you here, and we really love our Facebook friends that join us here. Let's get to our first headline. This is the world's most profitable company in 2018. It is by Mike Murphy at MarketWatch. And I just want to tell you guys, this is a shorter story that I chose because it's a very complicated situation. I'm going to bring in some research that I did to amplify what this story goes into because, as I said, it's not the usual story, and that's why I picked it. I think that this is something we should all be talking about. The author here is Mike Murphy, and the publisher is MarketWatch. Saudi oil giant Aramco generated a whopping $224 billion last year. Saudi Arabia's national oil company was the most profitable company on the planet in 2018, according to a new report. Citing data from Fitch Ratings, Bloomberg News reported on Sunday that Saudi Arabian oil company, known as Aramco, generated a whopping $224 billion last year, and that is before interest, tax, and depreciation. We often call that EBITDA. Apple was a distant second with $82 billion, followed by South Korea's Samsung Electronics, Royal Dutch Shell, Alphabet, which is basically the holding company for Google, and ExxonMobil. An expected initial public offering by Aramco didn't happen last year, but Saudi Arabia Crown Prince Mohammed bin Salman reportedly said in October that the oil giant would go public by 2021 with an expected valuation around $2 trillion. The Fitch report was a rare look at Aramco's secretive finances and comes ahead of a $10 billion bond offering for the company that may come as soon as this week. That, according to the Wall Street Journal, reported on Thursday. Fitch rated Aramco A+ for its first ever debt issuance. So this is the first time we're getting a look at this company's finances, and that's the significance of it. I did pull some other research that I think is important that we know to give some context to this story. So this is information that did come to us from Bloomberg. I've got a new computer stand, so that's why I'm messing with the camera here. All right. It is important to note that Aramco, as great as those numbers sound in terms of profit, they do not generate as much cash per barrel as other leading oil companies like Royal Dutch Shell, which you heard was just behind it on the list. And the reason, this is important, the reason is taxes. It's a very unique situation being in that country. And also, the reason that all these secrets are coming out after, its nationalization, which was back in the 1970s, is that Aramco is pitching a bond sale to investors, which was briefly mentioned in that piece. They want to buy a controlling stake in a domestic petrochemical company. So this is really kind of opening up what they call opening up the kimono and seeing what's been going on behind the scenes. Fitch Rating and Moody's rate its debt lower than oil majors like ExxonMobil and Chevron. And the company outlines the risk for investors if they do want to buy into this in this debt offering that's happening probably this week, or maybe in 2021, you're interested in the IPO because in theory, it sounds great. You might be very interested in learning more about the world's most profitable company. Certainly sounds good to me after, say, the Lyft IPO last week when that company doesn't even make a profit. So the risks for Aramco include, brace for this, my friends, missiles falling on Aramco's installations. That's a new one for me. Another risk includes the impact of the proposed U.S. antitrust laws on OPEC. That is certainly something that the company cannot control. Risks also include the fight against climate change, currency risk, and they also disclosed that they were the victim of a successful cyber attack back in 2012. Prince Mohammed, who we also mentioned in the piece, controls most of the levers of power in the kingdom. He's also wanted to pursue this IPO, and he talks about this $2 trillion valuation that they think they're going to get. But the truth is, they've been trying to get that. And so far, he's been getting pushback from investors. So that's the reason for its delay. So you have to wonder, what do these institutional investors see that is making them hesitant when it comes to picking up this IPO and getting this traction? Because, of course, we know that investors are very eager for IPOs that are attractive, even if there's a lot of things that maybe not so attractive. And we talked a lot in recent shows, including the Lyft IPO, about understanding the risks of an investment. And we talked about knowing behind the scenes what's going on. It may sound like a great company because of a growth rate, because of revenue. What are they really making? What are the risks for the company? These are things that we need to take in mind when we are making these investments. So I think that it's important that we discuss these. And for our Facebook Live audience, I'm also a little bit behind on the graphics, so I apologize for that. The takeaway here, guys, is that the biggest profits don't always justify the risks. And so when you look at Aramco or a company like that that has huge profits, what are the risks? And they may be risks that could be unusual, things that you don't always think about. For example, companies like an Apple, they were number 2, although they were far behind. They have a lot of third-party vendors that they work with. And so those are always a risk that it's important to be aware of when you're thinking about investing in a company. So I just think that it's important to look at the total picture, look behind the headline, understand what's going on, and make a decision that is going to be the right one for you, but that is a fully informed decision and that you go into with eyes wide open and really understanding what you're buying into and the unique situation of these. It's also important that this is a company that many of our listeners here are US based. This is not a US based company. So this is something where you have to understand the laws of that country and how that may impact it. In this case, another thing mentioned in that Bloomberg article is that the money from companies that are nationalized like Aramco can often be used, the tax money, to support the many princes and the royals that are in the country that do get supported by this. And we actually have an interesting comment by Greg here in our Facebook Live audience. So he is also echoing what I said, and that there is substantial political risk as an investor. And he adds that if they were publicly listed, the value of the prince would be put forward. They would be the biggest component of nearly every cap-weighted international index. That's actually very interesting because of his personal wealth, which of course is tied. And Mike is adding here political risk, economic risk, industry risk. So I think that those are all excellent points. And one more, let me just add, because I want to complete Gregory's thought. He said, yes, they were disappointed with the amount of equity that they thought they could raise from the listing. And that's why it's delayed. But now we're getting a look at this. We'll see. I think the company will probably evaluate how this debt offering goes, if in fact it goes forward this week. And then they will make the decision whether they do want to take the company public in 2021 to make this acquisition or for other reasons. As I mentioned, there are so many variables, including the price of oil. Now, the price of oil has been going up, so that could be a variable as well. All right, we are going to move on to the second headline, and that is from Considerable, which is a new publication, which I'm a big fan of. And the headline is 5 times it pays to take a pay cut. And if you do settle for less, how low should you go? It is by Daniel Bortz. Here we go, my friends. In an ideal world, your pay would keep going up, up, up until the day you retire. Don't count on it. Raises can be harder to come by late in your career, especially when you're already making a good living. Among college-educated workers, pay growth tends to top out at age 40 for women, early 50s for men, according to salary research site PayScale. Quote from Katie Bardaro, lead economist at PayScale. If you are in the twilight years of your career and expecting large pay increases, you'll probably be setting yourself up for disappointment. While your pay may naturally level off 10 to 20 years from retirement, you probably don't want it to actually fall. But in some cases, taking lower paying jobs can make financial sense. Here's why, plus advice on how low you should be willing to go. First off, you're switching to a new industry. Obviously, oops, I skipped ahead. Sorry about that. First off, your job is in serious danger. And I did want to read this in order because this is, unfortunately, probably one of the more common ones. Once you pass 50, you know that the risk of a layoff looms large. A recent study of workers over 50 by ProPublica and the Urban Institute found that more than half of workers who had seemingly stable full-time jobs at age 50 report being pushed out of at least one job, if not 2 or 3. Returning to the workforce after a late career layoff almost always goes hand in hand with a pay cut. When your company or division isn't doing well, finding a new job before you're laid off might be your best career move, says Bardaro. Quote, if you're working at a company that's laying off employees left and right, you need to think about job security. If you have the opportunity to take a lower paying job at a company that's more stable, it may make sense to make the jump. All right, another reason, you're moving to your future retirement town. As long as you're planning to move in retirement, you may want to finish out your career plan there as well. Depending on where you live and where you're moving to, you may have to take a pay cut to do so, says Michelle Armour, Career Builder's Chief People Officer. Salaries are typically related to the cost of living per city, she points out. Case in point, librarians. In San Francisco, they earn $81,690 a year on average, according to the Bureau of Labor Statistics. That is significantly more than the $62,470 average for librarians in Houston. Another reason, you're searching for better benefits. Out-of-pocket healthcare costs keep rising as you get older. Don't we know it? In 2017, 55 to 64-year-olds spent an average of $5,777 on healthcare, including insurance premiums, copays, and drug costs, according to the BLS's latest consumer expenditure survey. For 25 to 34-year-olds, the total was $3,163. That's why in those years leading up to Medicare's eligibility at 65, you may put heavy stock in a comprehensive health plan at work with a manageable deductible, a wide network of doctors, and favorable formulas for cost sharing. It is no surprise then that older workers highly value generous company coverage. In a recent survey from market research firm Clutch, 62% of baby boomers named health insurance the most crucial employee benefit. Fewer than half of younger workers felt that way. So if your current employer offers skimpy medical benefits, taking a lower paying job at a company with better coverage could be a smart move. Another reason, you are switching to a new industry. Obviously, some fields pay more than others. The industry and type of work someone is doing have an impact on the salary no matter how much experience, says Armour. Let's say you've been a nurse practitioner your whole career, but you've decided to leave that rigorous field and retrain to be a computer programmer. While nursing jobs are projected to have rapid job growth, the computer programming industry is expected to lose about 21,300 jobs between 2016 and 2026, according to the BLS. The average pay for a programmer is 20% less than what nurse practitioners make. You can make more money in the long run. That's another reason. When you're touring with taking a lower paying job, think about your long term earnings potential, not just your salary now. Perhaps you've topped out in your current job, and the one you've been offered has more upside. Quote, one thing you really want to focus on is how much you can make over time at that company or in that position. If you'd be taking a pay cut, you need to ask yourself, is this a job where I can get rewarded with bigger pay increases later on? How low should you go? Even if you have good reasons to accept a pay cut, you should do so within reason. Ask yourself these 3 questions before taking a job offer. Can you afford it? Even at a lower salary, can you still pay your debts, fund your retirement plans, and achieve other financial goals? If the answer is yes, you're on solid ground. I can't say that someone should never take a pay cut that's below 3% or 5% or another percentage, since it really depends on the person's financial situation. Is your lower salary near what the market pays? Even if you're willing to earn less, you don't want to sell yourself short. Knowing what a typical salary is for someone with your level of experience gives you a crucial point of reference for judging job offers. There are a number of online resources you can use to determine your market value in a new place or field. PayScale Salary Calculator will provide a rough estimate based on your occupation, location, and years of experience. You can also use Glassdoor to find salaries reported by real employees. And finally, are you negotiating as well as you can? You want to be very careful about placing a floor on what you're willing to accept because it can vary significantly based on your priorities and the other aspects of the job offer, says Bardaro. When reviewing an offer, look at vacation, time, teleworking options, and other perks too. Quote, you should always negotiate, Bardaro says. If an employer is making you an offer, the company wants you, which gives you leverage. Okay, I'm very interested in seeing the comments from our Facebook Live audience. And again, if you guys want to join, we do tape live in front of a Facebook audience at facebook.com/iStackBenjamins. All right, let's go to Kathy. Kathy says, lots of people get stuck in jobs they don't like because they pay good and have good insurance. True, that is an excellent point. But you may like the pay and you may like the good insurance. So it's a balance, and it's just about deciding what you really value the most. And it's kind of okay if it is pay, but it's also okay, as this article points out very well, if pay is not the number one thing. Maybe it's stability and job security. Maybe it's having health insurance to bridge that gap until you get to age 65 if you are, as this article is basically written to, over 50 years old, and that's something that you really value. And now Gregory is responding to Kathy's comment, saying Kathy touched on this, but I do think if there's a happiness factor in this decision as well. Lots of high earning attorneys, investment bankers, and management consultants end up burning out pretty quickly and usually look like they are 40 years old when they turn 30. Well, that's also a good point. You don't want to completely burn out, because if you burn out, then you end up leaving the job in the end in some way, generally, because you just can't do it anymore. And let's go to Mike with one more comment. And he says, if you are taking one step backwards in pay to join a new company with higher income growth opportunities, it could lead to multiple steps forward. I think that is an excellent point, that you also want to look at the health of the actual employer, because maybe you're moving to a startup, for example, and they're not going to pay you in money what you want to be paid, what you deserve to be paid, what the market is paying, but they can, first of all, possibly give you stock going forward, and that's a great thing to be negotiating for. But also, just the fact that the company's going to grow, the needs may be there, and there be maybe positions. You may find yourself getting experience you wouldn't get somewhere else, and you may find yourself in a higher position at a faster pace than you might have otherwise. As I promised our Facebook Live audience, I am now going to share my own personal story of taking a pay cut, which is something that I haven't really talked about in public much. But when I was behind the scenes working at CNBC and at CNN, I really did want to be on camera. I felt, for me, that was a way to, first of all, get credit for the work that I was doing behind the scenes, and also ultimately to make more money, because in general, the on-camera jobs paid more money, and it was really important to me. But I was in my mid-20s. I didn't have any real experience. I'd been making some tapes on the side, and an opportunity came up at PBS, which had the nightly business report, which is now owned by CNBC. So you guys can watch it there with my friend Sue Herrera, who was a great mentor to me back in my CNBC days. But at the time, there was a job offering there. The tricky thing was that It was a half producer job, half on air job. And it was junior to one of my closest friends who had just started working there less than a year before. And she was candid. She said, I didn't even know if I should tell you about this because this job is below my job. And I made a direct, parallel over, but this is what the opening is. Do you want to apply for it? Because it's kind of a step backwards and the pay would definitely be a step back. And so I thought about it. I interviewed for it. I was offered the job. And what I was able to negotiate was that although my salary was lower and the position was lower in theory, although it had this on-air component, which I did not have in the CNN job, what I did negotiate for was a year of training with an on-air coach. So I was able to get those skills and really be able to practice and be much stronger when they did finally put me on camera, which in the end did lead to the career that I wanted. So I was able to make that career pivot and add some really valuable skills, get some training paid for me by this employer, even though I had the lower title and the lower salary. And I was able to regain momentum and ultimately pretty quickly surpass where I had been when I was off camera being a producer. So that's my own personal story of why I took a pay cut. And I think that it definitely paid off for me in my career. Let's get a couple more quick comments from our audience before we get to our big idea. We have Greg chiming in. I definitely watched the Nightly Business Report. Thank you. I think it's a great show. It's actually still on CNBC, so you guys should check that out. Let's just talk quickly before we get to, actually, I had one. Before we get to the big idea, let's get to our sponsor, and that is Tiller. And I chose Tiller. I wanted to talk about Tiller today because it's really important to be organized when you are making these big career decisions or when you're making investment decisions, like whether to try to invest down the road in a company like Aramco or in any of the IPOs that we've been talking about lately. Being organized and knowing what's going on with your money is everything. And Tiller helps you manage your money by doing it. You can be much more efficient with it. It gives you spreadsheets both on Google Sheets and Excel. You can see what you're spending. You can see your transactions. You can see your balances. You can see your investments. If you want to learn more, go to stackingbenjamins.com/Tiller for more information. Now, let's get to the big idea. We did have one guess from a member of our audience that I am just looking for and I can't seem to find now. Well, we'll have to come back to that. Oh, wait, here we go. It is Kathy with a big idea. Don't do something new or different without first weighing the odds. I think that is an excellent guess, and it's actually kind of close to what we did come up with. Our big idea for today's show is that profit is in the eyes of the stakeholder, and I'm putting that on our Facebook page right now. Profit is in the eyes of the stakeholder. And I say that because, for example, in the case of Aramco, it may be that the most profitable company in the world, on the planet, which is pretty huge. And something, as I said, we didn't even know this because these documents were private before, but it does come with some serious risks. I think it's a pretty serious risk when you're worried about missiles. It's a pretty serious risk when you're worried about political factors that you really have no control over. And it's a serious risk when you talk about taxes that can just be adjusted or changed at any time without necessarily the checks and balances that we have in the United States. Corporate taxes do change everywhere. We've seen a big change here in the US with corporate taxes. But when you're dealing with a company that is overseas, that is even less predictable. And then the other way that profit is in the eyes of the stakeholder is that in some jobs, if you take a pay cut, your cash profits may go down. But if in your eyes the overall picture is worth it, then it is your win. And ultimately, it is up to you. It is your win. It's for you to decide what is right for you. If it's right for you to take that pay cut and make the right move for your career, whether it's stability, whether it's the right benefits like health insurance, it's you. So profit is in the eyes, profit is in the eyes of the stakeholder is our big idea for today. You guys have been wonderful. Thank you so much for joining us. Please check out Stacking Benjamins with my partner, Saul-Sehy, and absolutely check out Financial Grown Up, my other podcast. And if you want to live a rich life, you got to be a financial grown up. Bye, guys, and thank you so much.
This show is created by Saul-Sehy hosted and produced by Bobby Rebell and Joe Saul-Sehy, is engineered by Caden Thompson, and all put together by a pack of well-trained ferrets down here in Joe's mom's basement. You'll find Bobby at the Financial Grown-Up Podcast and Joe at the Stacking Benjamin Show. Go say hi to them there, too. Online, visit us on Twitter at Average Joe Money and at Bobby Rebell, or come join a live recording at our Facebook page. That's facebook.com/iStackBenjamins. I know you already know this too, but Money in the Morning is for entertainment purposes only. You should not act on anything recommended by a bunch of entertainers in a basement or even a Manhattan kitchen without first consulting your financial advisor. And second, dude, have your head examined. Have headlines you'd like us to discuss? Send them to joe@stackingbenjamins.com or put them on our Stacking Benjamins closed Facebook group. This show is a collaboration of Stacking Benjamins LLC and BRK Media LLC. Copyright 2019. All rights reserved. I'm Joe's mom's neighbor Doug, and I reserve the right to always say, we'll see you next time back here on Money in the Morning.